The presentation will be, I'll say, relatively interesting, but I think the Q&A will be far more interesting. Second, if you're trying to place my accent, I'm Portuguese. So that usually answers some questions. I've been in South Africa for a little more than a year. I've specialized in life insurance and wealth management. I do occasionally other types of work, but that's kind of the area that I like the most. And the reason why I do like life insurance is there's always this interesting dichotomy every time I do an assignment between what in by and large is companies that are quite stuck in their ways and the challenge and the disruption that you start seeing in the industry. And I'll talk a little bit about it. Initially, I think if you talk 5 years ago, I think it was all a little bit conceptual and many people would struggle to see how is this changing, how will this impact me? But I think now, and you start seeing in markets like Australia and UK, the industry, life insurance is a very, very different industry today than it was in 5 and 10 years ago. In Australia, I don't think anyone calls themselves life insurers anymore. They, by and large, call themselves wealth managers. I'll talk a little bit about it. I'll talk a little bit about what's happening in South Africa, and hopefully we can have a good conversation. The first point about InsureTech and FinTech is, I think the hype finally reached insurance. And I say hype because there is an element of hype in this. As you've all gone through the dot-com bust. But out of the hype and out of the bust, some things will stay. The sentence that you see in the slide, it actually comes from one of the most famous venture capitalists in Silicon Valley. And what he's saying is it's time for the insurance industry to change. Banking has changed, and I think you will recognize that. And the way we interact with a bank is fundamentally different from the way you interacted 5 years ago. And actually, if you look at this banking market in South Africa, by and large, the most successful banks are banks that have adopted innovation. I would look at FNB, right? And I think it's that type of innovation and change is happening and is coming to life insurance. PwC conducts annual CEO surveys. So what we do is we engage with the CEOs of large corporations across the globe, across multiple sectors, and we like to ask them what keeps them awake at night, and also why do they see change and what are the opportunities that come from that. It won't come as a surprise that most CEOs in the insurance space recognize the challenge from innovation, technology, and digital. I think what you see there, the stats of 88% of CEOs are concerned about changes in regulation. Many more or similar numbers with customer behavior, distribution, etc. The percentages are not really the key. I think the key is that, yes, if you talk to CEOs, if you talk to senior management, people are concerned. And I think you'd recognize that from your companies. I think every insurance company out there would talk about InsureTech, innovation, and all that. Everyone talks about it. I think the more interesting thing and the big challenge is what you do about it. I think most companies are still struggling to understand what should be the strategy and how they should act. I think as when we talk to CEOs, this also they recognize the opportunity, and I think you see some stats here in terms of how some of the companies are thinking on going about and using innovation to change their offerings. So it's not all challenge. There is some upside, but again, the question I think is how you go about it. So let me talk specifically about FinTech. And there is an element of hype. I think the hype, I like numbers, I imagine you all like numbers. The number of deals in FinTech globally has grown by 300% since 2010. It's exponential, and if you look at it in detail, there's now deals across all areas of FinTech, across all types of innovation. It's actually quite fascinating. Some things you say, this is absolutely amazing. Some things you say, really? Remain to be proven. But the fact is, the amount of activity that is happening globally is astonishing. And even in South Africa, there is several incubators in Cape Town. There's one that is being started in Braamfontein. Barclays Africa started their own exclusive incubator, which ran for most of last year. There's a few others going. If you look at Standard Bank, if you look at MMI, there's no shortage of financial institutions in South Africa that have set up either funds or are partnering with VC companies to do something. So this is not only Silicon Valley. Admittedly, the stuff that is happening in Silicon Valley is usually a little bit more exciting, but it is happening here as well. And I think what is more fascinating within fintech, what we call InsureTech, so the type of innovation that happens more in the insurance space, is growing. So in 2010, only 1/10 of the deals that were happening in fintech space were related to the insurance industry. If you look at the numbers now, it's 1/3. So I think insurance is getting an increasingly bigger share of something that is already a hype. So it's double hype, I guess. As I said, most incumbents are already doing something. You see some examples of global companies and how they've addressed it. I like to talk more about the South African examples, and I think it's probably something that will relate to you. If you've been following the industry, you know that MMI recently announced a partnership. You know that Standard Bank has done significant investments in many startup companies. I think one of the most famous ones is SnapScan. You know, as I said, Barclays Africa has teamed up with a known international incubating firm to invest and scale up a selected number of startups. But on top of that, these are the activity that we know, and it's public knowledge. I can tell you the other firms, both banks and insurance companies, are doing things as well. No one is sitting and doing nothing. And I think you'll recognize that from your companies. The million-dollar question is, which of these are actually going to result in something? Anyway. Having said this, there's still more to come. So when we did the CEO survey, as I said, most CEOs understand that there is significant change. And I'll talk a little bit where we see the change. I know that this stage is all a little bit generic. Less than half of the companies have a clear strategy on how they should address change. A quarter of companies are exploring partnerships, and the companies that I mentioned before is probably the best examples in South Africa. And only 14–15% have already started doing active partnerships and have the active deals with incubators. So big gap between I understand that I need to do something versus I understand what I need to do. And I think actually from my conversations with senior management, this is the biggest issue. Everyone knows that this is big. As I said, there's a lot of hype. I think if you're a CEO of Sanlam or Old Mutual, you can't not have heard about fintech and InsureTech and what someone is doing in Silicon Valley tens of times. What you as an established large company can do is usually the big question that many companies struggle with. So I'm trying to make this a little bit more specific. What can InsureTech do in insurance? What are the changes? What are the realm of possibilities that technology and innovation can offer? In our perspective, I think there are 6 areas that you should be looking for. The first one is new customer offerings. And we'll talk a little bit about it in a second, but just think about segmentation, new value propositions. How can you move from offerings that are destined to a large segment of the market to start sub-segmenting that in smaller and smaller chunks? And I think you start seeing a little bit of that in, for instance, short-term insurance, and I think you'll see more and more of that in life insurance. The second point is enhancing customer interactions. And that links very much with omni-channel, direct-to-consumer. How can you create direct engagement with your customers and how you can drive business from that? Thirdly, how can you augment your capabilities through partnerships? And I'll give you some specific examples of that are starting happening, very exciting. The fourth one is leveraging data and get better insight on customer and risk. Fifth, how do you improve underwriting and loss prevention and loss prediction? And sixth, how do you improve operations and operational efficiency? So a little bit more on each of these. So I think when you talk about new customer offerings and reaching the underinsured, and you start talking, for instance, about pay-as-you-go type of insurance, that I know there's already some offerings in the South African market. Lowering the cost of advice and being able to target customers that would be unaffordable in other ways. Peer-to-peer networks. It's quite an interesting concept. That's already happening in banking, and I imagine most of you are familiar with Lending Club, which is a platform where retail investors can advance money directly to companies. There are many discussions on creating the same format for insurance, where individual investors could provide capital to price individual risks. In many ways, you can see as Lloyd's of London market in a technology platform. Conceptually, it's actually quite easy to understand how it works. And there's companies and people thinking how you can do that. The second one, when we say interacting and improving the relationship with customers. In the UK and in Australia, D2C is a big deal. These days, Hargreaves Lansdowne is the 4th largest list platform in the UK. More than 20% of flows in investments go D2C. That for me is significant challenge. It's a significant challenge, it's a significant change, and is already happening. And in my view, it probably will happen in South Africa, where a significant proportion of investment flows will be disintermediated. And either go to traditional insurance companies, or we'll go to new players that can develop these propositions and these customer engagement tools that make customers comfortable using and investing directly online. Because that's already happening in other markets. And that, for me, will change insurance, as we know, dramatically. Augmenting existing capabilities through partnerships. One of the examples we'll show later is, for instance, take employee benefits. Can you improve and expand the offering, the traditional umbrella funds and group risk offering, by offering ancillary services that are relevant for corporates, using the data that you collect from their employees? And there's an example of a company that does that. Another example, one of the insurance companies here in South Africa has reached a partnership with a new startup that submits tax information to SARS. That's a way of expanding your service offering, a new capability. You help your clients now through their tax preparation. Think about the possibilities of that. If you know someone's tax declaration, you literally know everything about them. Absolutely. You know how much money they have, where they earn it, where they came from. What could you do with that information? And I can tell you at least one big insurance company in South Africa has that proposition. And that is a way of using partnerships to extend your capabilities and significantly, like this tremendous amount of value if you do this properly. Leveraging existing data and analytics, generate deeper risk insights. I think the big discussion here is wearables. I think you've heard about, and you've seen Apple Watch, you've seen the craze about all these Fitbits and tracking devices and what Vitality is doing. You can go one step further. You can know everything about your customers, about where they are, what they're doing, what's their health, real-time monitoring. How can you use that information to know more about their habits and to price the risks better? New approaches to underwrite risk and predicting loss. If you have that more deeper and more granular customer knowledge, how can you translate into better risk pricing models? I think we all know, and I think short-term insurance is a good illustration of how life could change as well. Take OUTsurance. OUTsurance has a model that prices car insurance and motor risks in using 40-something variables. It's a far more granular model that the industry traditionally have. Once you get that kind of customer information, and once you know how to use that customer information to price risk, can you change your market? Yes, you can. The interesting thing is it allows you to go after customers that are more profitable and allows you to give the customers that you don't really want to your competitors. Which is, to be honest, that's what OUTsurance is doing. And by the way, OUTsurance has a return on equity of 25% plus. It's the only car insurance company that I know that has that kind of returns. You should go to the UK or Australia in the States and say that there's a car insurance company that has returns of 25%, and people will laugh. Unheard of. Absolutely unheard of. And lastly, how can we improve operational efficiency? There's examples of many things that you can do. One that I would like to highlight is the emergence of software as a service. the emergence of new technology or new policy administration systems, there can be run off the shelf. Many of your companies, you'll see one of the biggest drags you have is how do you manage all the legacy books and all the IT infrastructure that comes with it. Imagine competing with a new company that has a far simpler product offering that is run on a off-the-shelf policy administration system that, by the way, is in the cloud. Just think about the cost of administering that policy versus the cost of your company is incurring to administer their policies.
George, maybe just in the context of the South African environment, microinsurance has been like the holy grail in terms of the ability to sell to a large number of people without having to incur significant distribution costs, because that's been the inhibitor for that. Do you see this, based on what the conversation you've had, is somebody going to crack that using technology, or is that a different game?
I think technology will go a long way, because you've mentioned distribution, and I think you're right. I think that's the biggest chunk of cost that is currently inhibiting targeting that segment. But if you think about the entire value chain, there's cost all along the way. So if you look at the traditional life insurance company, not naming anyone here, you have a overly complex product set, which we're probably talking hundreds and hundreds of combinations. They are administered over multiple IT platforms with underwriting processes that are by and large manual, with the use of medical for most of this, which adds another set. Let's not even talk about the investment management side, let's park that aside. With the claims handling process that is, to a certain extent, manual, and a distribution process that is highly complex by virtue of one, by and large, there's still the use of third-party intermediaries. Second, the fragmentation and the proliferation of products reflects itself in the advice process, because you do need to go through the different products and be able to highlight and provide evidence to the regulator why product A is better than product B given the customer needs. So you say, look, if you go through the entire value chain and you say, for someone who has very simple needs, I only have 1 or 2 or 5 products, and you can call it gold, bronze, and silver, that is managed on an off-the-shelf policy system that is on the cloud, so I only pay per policy on a variable basis, there's no fixed cost on that. That I then try to have the underwriting process completely automated, even if the cost of having to accept some, having to price additional risk from doing that. Automate the claims management process, and then you combine distribution through an extremely efficient agency force, through partnerships, and potentially through better use of direct. What? Exactly. And you can, yes, change the format of the product to allow for infrequent usage. What would be the total cost of doing this? Would be much lower. So would that allow you to target customers that currently are unprofitable? Yes. If you look at the overall spectrum of the population, it's the problem of South Africa is the majority of the population is on LSMs 1 to 6, which clearly you're not going to be able to target LSMs 1, 2, 3, and 4, but if you can just take the curve from LSM 9, which I imagine where most insurers are these days, to LSM 6, the number of customers that are now in play is tremendous. And even if the average profit per policy is lower, the volume that will make the game. And finally, and I think then there's a long-term discussion, if you look at the average customer profile, the social demographic profile, and the average social demographic profile of your advisor, and if you do you think that these are the customers of the future? So then I think if you're an insurance company that takes a long-term view of the market in terms of 15, 20 years view of the market, just look at the average social demographic of customer base. These will not be the customers in 20 years' time, because that's not the social demographic of the country as a whole. And if you look at the segments that are growing, both from an income and LSM and social demographic, the customer base that insurers have, by and large, in their base, is not the customer base that is growing in this country. To make matters worse, the average advisor could not be further away so in a from a social demographic perspective, to the type of customers that most people want to target. So clearly you have to change. I think technology will allow you to target that. It's just thinking in the banking model, Capitec. There's nothing particularly rocket science that they've done. But they've done it well, right? They have until recently they had one product that did three things. It was transaction account that was also doubled as a savings account, and they had personal loans. They had an extremely efficient fulfillment process. So for those of you that don't know, by the time you leave the Capitec branch, the product is activated. So there's no back office, someone sending you stuff. Like you go to the branch, you enroll. By the time you leave, everything is ready to go. It's activated. And from an IT perspective, it's all designed for that element of simplicity. The end-to-end cost of offering a service that has been around in this industry for decades is a fraction of the cost that ABSA and Standard Bank and the others have to do. Can something like this be done in insurance? It can. Like, if you think about it, I'm sure you can. If you had to start a new insurance company, I'm sure you can do a far better one that you have currently at a fraction of the cost. The scary part is now that there's money, because if you look at the stats about fintech and InsureTech, the only thing that is saying is there's a lot of people with a lot of money that want to invest in things like this. So if you have an idea that you think can make money, there will be people there who will be willing to give you money. In South Africa. Will that change the industry? I think we will. I would suggest even further. I don't think the industry in the current format will survive for much longer. Which goes back to the discussion we're having, both from the product complexity, both from an advisor and distribution perspective. You will have to change anyway. I have some more pages, but I would appreciate questions. I think this is far more interesting than the presentation, seriously. Come on.
Just a question. Why do you believe South African insurers are slow, let me put it that way, to move away from legacy systems? There may be some obvious answers, but just give me some of the things that you've been saying. Because I think, firstly, do you accept that it is a reality that they are somewhat slow to move away from legacy systems? And secondly, if so, why is there that slowness relative to the rest of the world?
So for the first question, they're slow. I'm not sure if they're slower, because I've worked quite extensively in the UK, and I think is, if anything, equally worse. I'll have to tell you a story. I worked for one of the big mutual companies in the UK and wanted to do, it was a strategic review, and we said, we'd like to understand the social demographic profile of your customer base. And so the close book of that company was being managed by an outsourcer, and they say, we'll probably take 3 to 4 months for them to give you the data that we have on the customers. Just age, address, 3 to 4 months for you from between understanding what information do you need until you actually get basic social demographic data for the majority of policies of that company. It's ridiculous. Seriously, I have no hope in hell. But anyway, so to addressing your question, I think many insurers in South Africa have come through mergers, and that does not help, because the traditional approach to this is you merge and you keep the systems as they are, and you manage them in a highly federated manner. And so you keep avoiding making decisions, so you just keep kind of plastering up until you get to a point. If you look at an old mutual, if you look at a Sanlam, if you were to change all the current policy administration systems into one, the cost would be crazy. It actually would be very difficult to make a business case that stacks up. And that's why, for instance, in UK, the easiest way it's to outsource the thing. Just like make someone else's problem, as opposed to try to outsource it. And admittedly, that will probably be always the most effective way of dealing it, because what you have is a variety of systems that many of them just deal with a handful of policy that you have to keep until they lapse. But then, which is the problem of the insurance industry. In the banking industry, mortgages get rebrokered eventually, and Even the oldest of mortgages will not be around for more than 5-10 years. How many policies do you have that are 10-20 years in your systems? And you have to keep the system that administers this thing. So I think unfortunately the industry does have a structural issue, which is by virtue of being long-term. I think the fact is most of the 4 big players, if I take Discovery out of the equation, have by and large got here through mergers and acquisitions. And most of those mergers and acquisitions never really focus on cleaning up the operational mess. That kind of explains a little bit where you are. I think, lastly, if I were to offer perhaps an industry that if people are quite stuck in their own ways, and it's a bit, financially it will be a bit difficult to make a business case that stacks up that you need to do a new, you need to do a replatforming exercise, assuming that that is the right answer. Not necessarily always is. But in many cases, and I've seen in the banking industry, you do it because you see the future. You see, look, from a cost perspective and from the investment, you might not make it, but if I don't do this, there's all sorts of things that I won't be able to do it. So if you look at what Standard Bank is spending in their new core banking application, it's a bit, I haven't seen the business case behind it. I would offer that that business case perhaps didn't stack up, right? And you probably still might say that was a completely crazy idea because the numbers are crazy for the South African reality. But on the other hand, what can you do if your core banking system is not even real time? Right? If you want to understand what's your current exposure across your customers and your system doesn't do it. So eventually you kind of say, look, the future is something different and you have to bite the bullet. And perhaps insurance is an industry that struggles with that kind of concept, I guess. Sorry. I think there's someone raised. No. Go for it. So, if you were to think that the business that you have today is not the business that you want in the future, which I would suggest is the case for some insurance companies. And look, if you believe in this, in my thesis that the industry of the future will probably be far simpler from a product perspective, far fewer products, far simpler products, from an investment perspective with far fewer guarantees, much more transparent, from a risk perspective with far fewer number of combinations that are easy to understand and communicate to the customer. Is the best way to deal with your legacy to invest more money in it or to just make it someone else's problem? Because to start fresh, the answer is actually quite easy. To start fresh, you wouldn't invest billions in a new IT system. I can tell you that. That makes no sense. If you start fresh, talk to someone, because there are people there that will give you one of these for almost free, where you pay on a variable basis. And it makes sense. If you're starting a new business, you want to pay on a variable basis. Why are you going to pay $1 billion or plus upfront investment when you can have a system that is on the cloud and you pay per policy? And it's actually much easier to then account it and charge it to the customer. You just think, even from an accounting perspective, it's easy for everyone. So then in that perspective, if you think that your new business and your strategy is completely different, I don't think the right answer is to sunk money in the legacy. I think the right answer is probably to do what the guys in UK did, make it someone else's problem. And there's a nice business to be had in terms of managing back books for efficiency. It's not an interesting business, in my view. I wouldn't like to do it. But there's a lot of people that make good money in managing that. There's outsourcers like Capita that and then you have scale. And then Liberty and MMI and Salem, they all sell their back books, and these guys get real scale out of it. They'll make money. For the insurance company, what you get a problem off your hands, and you get actually management bandwidth to think, if the industry is different, if the future is different, let me focus my energy and my attention and my RAN money into this new business. And the new business, you can do it in a very, very different way. If you think that your future is a continuation of the past in some shape or form, If you think that your new business will be a variant of what you've been doing today, then perhaps it makes sense to then just get your house in order. But I think it really depends on where you see how big a change you are. I think, to be specific, I think some companies, if you were an old Mutual and Sanlam, perhaps it would be a bit radical to say, like, just get rid of everything and start fresh. But there'll be, if you look at the mid-tier, why not? Seriously, this is an industry that is dominated by 4, and Discovery managed to join the group. If you're not one of these 4, what do you have to lose? I don't know. Yeah.
Well, that's an interesting thought. The question is, as you say, insurers feel they lose control when they go into a bank. And they feel that they won't be able to get the front office to talk to whatever back office. But then I agree that there's people that have done that, but it is massive.
Yeah.
Yeah, I think just to add to that, I concur with that. I think with the likes of the Panama Papers and these leaks and this whole thing about liberties and confidentiality of personal information,
Mm-hmm.
I think from a South African environment, I agree that that's kind of off-putting in terms of what's been happening in that space.
Yeah.
From a pure consumer confidentiality perspective. But what are your views on that? And just maybe
Yeah.
to add to bolt onto that, because robotics and automation, and I think one typically thinks of that as something that's a bit more tangible, as opposed to something that's overlaid on an insurance product.
Mm-hmm.
I think that's really the thinking in the environment at the moment.
Okay. I'm happy to answer that. So on the first one, I have to, PwC is moving to Google Mail. There you go. I worked for a strategy consulting firm that was acquired by PwC. So I came to see PwC as the most compliant organization in the world. And perhaps it isn't, but that's that kind of cultural shock. And if PwC can move to Google Mail, oh my God, anyone can. So that's my view. I'll leave my PwC colleagues to elaborate on the subject. But if even PwC managed to make a case that from a personal copy and confidentiality and all these things, it's fine to send our emails to Google, and clearly we don't have an average run-of-the-mill Gmail account. We have a corporate Google Mail account. Those things exist, but it is on the cloud. And I'm not a techie, by the way, but I take that as great comfort that if PwC managed to do it, I think anyone else can. On the robotics and automation, I think I think when people think of robotics, they think of a manual arm that starts yielding stuff on cars, right? So perhaps that's not the kind of robotics that we're talking, but in terms of automation, I would really encourage to have a deep look at it. If you just take the risk side of the life insurance business and just think about the amount of complexity and terrible customer experience, by the way, that you add by through the entire process of talking to an advisor, doing a medical, to then have a partially underwritten, then to fully underwrite the thing, to get some stuff on the papers, and then through the email, and then the claims management. How much of this could you automate, even at the cost of potentially higher loss? And if you price that in the quote, wouldn't this be a much better product for the customer? Seriously, doing a medical? I have a corporate life. I've never done a medical for life insurance, and I find that amazing. We've done this for one of our clients. Just the amount of time spent just to get a life insurance policy, it's just bonkers. Seriously. 2 months? For what? For a term life cover? It's just... So really, if you think about it, you just challenge it a little bit. Can you really automate some of this and recognize the automation will drive higher probability of risk and loss? Price that in the product. Can you still get a better product from a customer perspective? You can. If you look at it from an operational perspective, what is the biggest source of cost in this business is distribution. If you can increase the productivity of the advice force, the name of the game is completely different. So yeah, so I take your point. It's not about an arm welding stuff in cars, but can you do a product that is so much simpler, so much different, so much better customer experience, that you drive advisor productivity dramatically, you simplify the cost across the value chain, and you have a completely different, I would say, experience and proposition to the customer? Yeah, I think you can. Yeah.
If there are any final questions, let's do that. And we'll have it.
Go for it.
So do you see opportunities to roll out some of these ideas to the rest of Africa?
Yeah, absolutely.
And if so, which ones? Because some countries don't have smartphones the way that we do, or the same access to data that we do.
Mm-hmm. So countries individually, it's a bit difficult to comment. Do I see an opportunity to do this across Africa? Yes. There's this example in Kenya, and it's a completely different example, but you can see if they can do it, we should be able to do it. So one of the big businesses in Kenya these days is the solar panels. Right? You sell solar panels. The company that sells these solar panels does basically on a long-term financing deal, and the money is deducted from your airtime in your mobile phone. And because there's unreliable or virtually no power generation, that actually is a game changer, right? Now you have a solar panel that you can use to power your phones and do all these things. Actually power the phone, the same phone that you use to then deduct the cost of the financing deal. Seriously, if they can do this, couldn't an insurance company use, again, a very simple proposition that it can be where the premium, for instance, is deducted from the airtime? And just, again, this is clearly not the solution. It needs to be further thought through. But if solar panels is the thing that has shown up in The Economist twice, and if they can do it, like seriously, this can't be that difficult. It just can't be that difficult.
Just something to notice that we might be thinking in smartphone terms, but those transactions are not using smartphones.
Yeah.
They're using the old basic.
Yeah.
It's just the USSD messaging. And so technology does not have to be this.
Yeah.
It can be a whole lot more simple, and that's how these things are happening. And that's also data. Just because we see a picture doesn't mean that's the only form.
Yeah.
So it's actually a lot simpler.
Yeah. And what I would encourage, the thinking has to be across the entire value chain, because where we get stuck, and you're probably thinking, how can you sell our risk product over a regular, like an old school Nokia phone that we used to have? You can't. The answer is you can't. But can you have one life insurance product, like Capitec has one banking product? So I've done that analysis. FNB in their website has 100 and something products. Capitec has one. So this is not unusual or unheard of. Someone has already done this before. So can you go with one insurance product? One. It's probably appropriate. It fits only really 5%, but for the other 95% of customers, it's good enough. Because that's the problem in insurance, is the concept of good enough versus perfect. Forget the perfect, it's good enough. And with one product, you don't really need much explanation. Right? And then, yes, can the premiums be paid from airtime? Yes, they could. Could you then link the fulfillment of this through the telco company? Can you talk to Safaricom to do this? Yes, you can. Can you do something like this in other African countries? I imagine so. Again, I think country by country it depends on the infrastructure, the level of sophistication, telco providers. Look, there's all sorts of variables. But for me, when I read that the latest craze is solar panels, which is something that we think is like this fancy stuff that you buy and put on your roof, and they managed to do a mass market industry in Kenya, it's like, it can't be that difficult. For me, solar panel has to be more difficult than term life. It should be.